top of the morning. I think we're going to name this Turban Otter Jefferson. And I got a David Taylor tie, fine vintage David Taylor here. Today, going to run through a full portfolio process. Got a new theory to share with everybody. It's a good one, solid one. Come up with a new portfolio and then monitor that going forward. And before I get into that, quick disclaimer, reminder everybody, this is for educational and entertainment purposes only. And with that, let's get into it. August 24th, 2026, the Jefferson portfolio. Remind everybody what the portfolio process is. And the first step is to come up with a hypothesis and then set up some rules for our portfolio. The hypothesis today is we're going to leverage the financial research done by experts. This data is available free of charge on your brokerage account. In this case, I'm going to use Fidelity. They provide Jefferson's recommendations, and we're going to use those recommendations to build a portfolio. The hypothesis is the recommendations are good, and we'll start with Jefferson Research, and we're going to go sift through their whole list of recommended buys. Then we're going to find the top 30 or so that are efficient, and we're going to produce a portfolio. The rules are going to be, we're going to buy this thing, just for example purposes, all at once. Rebalance every 2 years. We're going to look for stocks that might drop significantly, and then also we're going to go revisit this every couple years and see if there's anything better that shows up, new things that Jefferson points out that Jefferson might recommend, a new buy by Jefferson. And of course, reinvest all dividends, and if a stock goes up too much, we'll also pull back on that one, and we'll take some of that top performing stock and we'll buy some of the middle performing stocks with that. Next, let's do the stock search. And the stock search is super simple. This is going into Fidelity, going into stock search, select Jefferson Research as your financial analyst, and we're going to click buy, and it's going to come up with 386 stocks. All right, so we got 386. We're going to download these and then run those through the Efficient Frontier. Next, we're going to go into Portfolio Visualizer, go into the Efficient Frontier. For this one, because they're recommended buys, let's go look at recent data. So we're going to sift through this using the last 5 years. And then for those stocks that are less than 5 years old, we're going to go ahead and pull those out of the search. So this BCLI, we're going to throw it out because it hasn't been around for 5 years. And when we do the first 100, we're going to end up with an Efficient Frontier that looks like this. This is the 100 stocks in the first one. And what we're going to do is go over and look at 20% here. So pick the 20% point, click on that, and that'll give us a portfolio of stocks that make up this 20%. We're going to end up making a portfolio that's equally weighted. So if there's 20 stocks, there's 5% each type of thing. 30 is 3.33% each. So ignore the percentages, but we want the list. So this is the first list, and then we'll go grab the next 100 and grab its list by clicking on 20%. Go grab the next 100, go click on the 20% again. See, expected return 20%. These are the stocks. And we'll click on the last 86 stocks. 86 stocks here, Efficient Frontier, click on 20, and we'll get the last list. And then we'll take these 4 little lists, and we're going to run those through the Efficient Frontier again. Because we can only process 150, in this case, we only processed 100 at a time. We're going to do 100, 100, 100, 100, and then take those resulting 80 or so stocks and run them through again and come up with our final list. This is our final list of stocks that make up our initial portfolio. And then one note, one of the stocks that it came up with, this Torex Gold, Fidelity wouldn't trade it in the baskets. It's too illiquid. So we're going to go ahead and throw this out. And I grabbed another one, same sector, same Jefferson buy, another gold stock, RS, Reliance Inc. So swap out Torex for Reliance. And now we're going to drop this portfolio into Morningstar, and we're going to look at diversification. In this case, we're looking at each sector. So for basic materials, there's 3 of them. Consumer, cyclical, there's 4. 1 financial, 0 real estate, communication services, etc. And there's 10 in the healthcare. So we're going to remove 5 of the ones from healthcare. And because we're going to make this equally weighted, we don't want 10. So let's get this down to 5. Let's get rid of 5 of those stocks and replace them with 2. Okay, so here's the 10 healthcare ones. We ran them through the Efficient Frontier, and we're just looking at the max Sharpe ratio. We can see that a couple of them didn't even make the max Sharpe ratio, and these are our 5 winners. So our losers are going to be the CRVO, Johnson & Johnson, BSX, Cellcurity, and ImmuCell. And in their place, we're going to add ANET for tech and ORI for financial to bring those up closer to the percentages that are in the S&P 500. Here's the resulting portfolio after changes. We are 97% US, 3% foreign. So we didn't try to get any foreign, but we got a little bit of foreign. Interestingly enough, these are a lot of small caps. And here's our percentages. We are lower than the S&P for technology, lower financial services, real estate, and utilities. Next is to go look at how we expect this portfolio to perform. So again, we're going to take that resulting portfolio, the Jefferson 2026 portfolio, and we're going to go, if you click on the link, Jefferson, click on that button, we can see that this portfolio in the last 5 years has earned 25% with 11% standard deviation. Crazy numbers. These are quite optimistic. So we're going to use Portfolio Visualizer to grab a longer time period with all the data. And turns out we can go back another 4 years, go back to 2018, which collects all the stocks. And this gives us a more realistic set of returns. So it's still 20% return. Standard deviation is 14. That gives us a -2 sigma of 8.9%. But one thing to note is this -2 sigma number gives us an annual number, not a drawdown number. We can see that the annual over the last 8 years was -8.999, and we predict 8.90. Pretty close to the prediction. But we can see that the drawdown is actually much bigger, and that's going to be in intra-month in the year. So in the year it went way down and came back up, but the worst year was -9%, the worst drawdown -16. This portfolio is going to move around a bit, a little more than the S&P 500, but it ought to make a little more than the S&P 500, at least predicted-wise. Next, we're going to go purchase the portfolio. I bought most of this on Friday, and then I did the RS replacement today. A quick summary. So we ran through the full process. We got a new theory. We set up rules. We found some stocks. We filtered for diversification. We set up the portfolio. And now all we have to do is go monitor this going into the future. That's it for today. Top of the morning. Reminder to everybody, the portfolio matters. And with that, I will retire a fine, mostly orange tie. Bidding everybody top of the morning.